Okay. Just about to start the No Bondcast here. A few seconds. Oh, ready to go. Excellent. Matt, can you hear me?
Boom, I'm here.
Boom. Excellent. Well, welcome everybody. We're here with another episode of the No Bondcast. My name is Beck, co-founder, chief investment officer of Beck Bode Wealth Management, here with my esteemed colleague and friend, Matt Morizio. How you doing, Matt?
Awesome. Good to see you, man. This is great. I'm fired up to have this conversation.
It's funny. We've done a lot of these webinars, No Bondcast, and we have yet until today to talk about what is our flagship strategy. Great flag behind you, by the way. That's fantastic.
Thank you.
Our flagship strategy, the Beck Bode Growth Strategy. So fired up to talk about this today for sure.
Yeah, I agree. And for anybody that's watching, listening, anybody that's going to watch us on the replay, Ben and I talked about what's the best way to go about having this convo so it's most useful for the listeners and the viewers. And I think it's best for me to play the role, because it was not that long ago, and I'll share how this strategy got introduced to me, but I'll play the role of investor or client or potential client or somebody looking to manage or have their money managed. And I'll just fire away. I'll ask all the hard-hitting questions to Ben, because he's been running the strategy for a while, a whole lot longer than I have. But I want to tell you, I'll start with how this got introduced to me. And then I want to hear, Ben, you just explain what it is in a nutshell. Sure. But I was at a time in my life where I was struggling mentally, to be totally honest. Professionally, I was doing really well. I had 4 kids at the time. And I can remember just getting back from a trip from Cabo. It was an all-inclusive, like all-incentive paid trip as part of a top performer for the previous company I worked for. And I was sitting out on the beach for their like gala event. And there are people dressed up to the nines. And I'm looking out there. And honestly, I'm having this realization, thinking to myself, gosh, I don't want any of their futures. I don't want any of their lives. And that's a problem, because I'm here at the very top in the company's eyes, right? I didn't really have much other place to go.
Missing.
Yeah, something was missing. And I said, so I knew that wasn't going to be a career for me. Meanwhile, I had 4 kids, like I said, had no real knowledge of what I should be doing with my money. But I had, prior to that career, had played baseball professionally. So I'd interacted with I fooled a bunch of financial advisors thinking I was going to make enough money one day to be their client. But everybody I had talked to there sounded really confusing to me and sounded very similar to me. I couldn't really discern who was the person that was going to be the one for me. And up until that point, I had basically seen all of the success I'd ever had in my life because I challenged that status quo, right? If you're trying, as a high schooler, if you're trying to make it to the professional ranks in baseball, that was what I was playing, you're going to run up to a bunch of people. When you say, I want to be a pro baseball player, they're going to be like, oh, that's really good. That's cute. Nice dream. But like, we should have something a little more realistic. If I had followed convention, conventional advice, then I would never have made it to where I made it to. So like my entire life was based upon this premise of challenging that status quo. And here I am having 4 children trying to figure out what the heck to do with their futures in a professionally successful career, but mentally stuck, thinking like, all this sounds confusing. I don't know what I'm supposed to be doing. I know doesn't feel right to emotionally go with the flow. Like, I don't want the life that everybody else has. Right. So in comes like a knight in shining armor, Ben Beck. He and I get coffee. Yep. He parked his stallion outside of Starbucks. And he introduced this. So we had a good, awesome talk for a lot of reasons.
Well, tell the truth. We were at Be Good in Dedham, probably, because that's where we're all
that was your first,
right?
That was your first time ever going to Be Good.
That's right.
First time that week, probably. So but he taught me about this investment strategy that you're going to learn that totally changed my perspective on how money gets managed and what the investing world really was all about. Like, you don't need a PhD in economics to actually understand it. And from then on, my entire relationship with money has changed, and I'm a completely different person as a result. But I want to hear, Ben, straight from the horse's mouth, so to speak, like, what is the growth strategy? Why is this so much different, or any different from anything else that people are hearing nowadays?
Yeah, well, certainly great recap of your coming of age with investing, right? And integrating what has been, you and your life and how you've approached life and philosophy, and really applying that, finding a place where you can apply that to helping people invest and achieve their most cherished, right, financial dreams and objectives. And you said one thing there that's really indicative of the strategy is that there's really nothing in our lives, certainly not in investing, where superior performance doesn't come from doing what the majority does. Right. And it's not for the sake of or being an outlier just for the sake of being an outlier, but it truly, in a lot of things in life, the growth in our lives, the growth in investments, the growth in companies comes from change. Yeah. It comes from distress. It comes from challenge. It comes then as a result, you think of companies or human beings, it comes from doing something different, innovating, responding to that challenge, getting knocked down. That's where that growth comes from in a lot of aspects of our lives, and certainly in the investment world. And, when you think about the mechanics, as you asked about, of the growth strategy in general, it's really all about that, right? I mean, if you look at it, the way the growth strategy was initially put together and how we run it as a company, we are replicating what very successful, or we're replicating the characteristics of very successful investors. Not all investors, very successful investors. And we've boiled it down to three major things that are indicative of successful investors. One is that investors become very, very successful by having a game plan, right? Before they get started, having a strict process that they follow. And, we quantify that as three questions: what to buy, clearly outlined strategy on what to buy, when to sell, the most important question in investing success, then where to reinvest the proceeds. Crucial in terms of having those questions answered before we even get started. Second most important thing, not in terms of performance necessarily, is data, research. We're only as good as the quality of the research that we have at our fingertips and the ability to use that properly. The data that we collect and analyze on a daily basis is from some of the top research analysts in the world. And that's really important. When it comes to making decisions with your money as an individual investor, I'm sorry, it can't be from a tip that you get at the golf course. So you open a magazine and you read something about what this company is doing or that company is doing. The top of the line data comes from the folks, the men and women who are at the pinnacles of their career with top research firms on Wall Street or otherwise. And the ability to use that information properly in the context of answering those three questions is also a vital part of the process. But, one of the most overlooked things, the third, in my mind, is that very, very successful investors know that at times that success can be kind of like watching paint dry, right? In the sense that rarely does an idea, a company, go from obscurity, nobody knows about them, to prominence overnight, right? That is, there are a number of companies that we think of household names today that weren't even around 15 years ago. Right. They weren't, so it takes a lot of patience in order to have a lot of success. And that's a really, really important part of the strategy in terms of having success, is understanding that you're going to put a lot of work in. There's going to be time and sweat equity, so to speak, put into this, like anything else in life, right? And you're not necessarily going to see the results in a week or a month or 6 months. So there's an element of the patience, but maybe the better word is faith. When you really come down to it.
Well, let's back up then. As a investor, and previously I thought, like, you told me the first of the process, which speaks to me, the discipline, consistent execution of anything in life is where success happens, right? I know what to eat. I just need to do it every day. Otherwise, but the process, what to buy, when do you sell, what do you reinvest in? Prior to joining the industry, that sounded like a no-brainer. Doesn't everybody do that? So talk to me about what to buy. Like, I thought everybody knew what to buy. I thought that's why I paid for a financial advisor. Right.
Yeah. Really important question and somewhat irrelevant in a sense, because information moves so incredibly quickly today that to have an advantage, I know it's talked about a lot. It's talked about tremendously about this stock or that stock or what you should be buying today or based on these numbers is talked about. Really, really difficult to get an advantage in terms of knowing what to buy today. But we do quantify that. We do cull the universe down based upon our criteria. We focus using our top of the line data. We focus on companies out of a universe of about 3,500 to 4,000 publicly traded companies. So names like Amazon and Apple and Lululemon and Constellation Brands. But all, other names that aren't household names to make up about 4,000. And we call that universe down to about 150 names. And that list is created by companies that stand apart from the pack in the sense that the analysts that we follow are estimating these companies' earnings on a regular basis. And these particular companies show characteristics of having their estimates raised twice in a 6-month period. So what that means is that Matt Morizio, top Wall Street analyst, is covering the healthcare industry, and he's saying hypothetically Biogen or Edwards Life Science or another healthcare name, we really think this company is going to earn $1.15 per share over the next 12 months. But we know the future is a moving target, right? The one guarantee that we have is that tomorrow is going to be different from today, and that affects companies. There's new information that's learned after the fact.
Yep.
And so Matt Morizio, the analyst, comes back and says, what I thought a month ago, I now, Biogen is going to earn $1.25 a share versus $1.15 a share. So we're raising their earnings estimate by 10 cents. And so what any investor, successful investor, wants to be in front of is a company today where their earnings estimates of that company are raised multiple times in the future. Because stock prices, which we don't pay any attention to, by the way, but the prices of stocks, which represent all that's known about the company today in terms of evaluation, they're not pushed up by events in the past. Coca-Cola is not pushed up, by the fact that they may have raised their dividend by every year for the past 15 years. What does make stocks move is expectations of future earnings. Mm-hmm. And that's why it's so crucial to follow not what has happened, but what is expected to happen. And the quality of that expectation, in other words, the quality of the analysis, the analyst, the person that's in charge of providing that, is paramount. Mm. And when we own a company where the analyst comes back not once, but twice, but 3, 4, 10 times over the next couple of years and continually raises the estimate, in effect, Matt, saying, a month ago when I said $1.15, we're figuring out now we underestimated that. We now think it's $1.25. That's good news. And that's what we want to be in front of multiple times in the future.
Awesome. So we're buying, to summarize, we're buying companies that have consistently brighter futures in the eyes of the top analysts on Wall Street. Their future keeps getting brighter. And more importantly, we're looking to when the analyst is struggling to predict the future. So these analysts are like the weathermen of Wall Street.
Sure.
So their job is to predict the future of these companies. And they're saying I'm struggling, but it keeps getting better.
Right.
That's a company you want to own.
Absolutely.
So then conversely, again, I used to think, doesn't everybody know when they're going to sell? Doesn't that make sense as an investor? Don't you have to know, buy low, sell high? Isn't that like a common thing? So when do you sell? When do we sell in the growth strategy?
Well, I think it's important in your comment. You're right. You'd think that, but a lot of folks focus on the price of an investment in terms of an indication of perhaps when to sell something. Yeah. So you look at if you separate people into two types, traders and investors. A trader looks at a stock, a company, and says, I want to buy it for $20 and I want to sell it when it gets to $30. I'm focusing my efforts on the price and the price movement of that company. I don't care who the CEO is. I don't care what the company is. I just care about that number going from 20 to 30, up 50%. Whereas an investor is not so much worried about the day-to-day fluctuations of a company, but is more interested in owning that company at $20 and still owning that company when it reaches $80 or $100. And the only way you can do that is to not focus on price, but to focus on something that is above price, that can lead you, that can direct you in the future. And so having a strict sell discipline and an effective sell discipline has to do with traveling out there into the unknown and understanding that I'm counting on the analysts. You said struggle a moment ago. I'll flat out say wrong. We're counting on the analyst to be wrong. Yep. And we make money when the analyst is wrong. We make money when they come back and say, I underestimated. We now think they're going to earn this much more. Come back again, I underestimated. So we're not looking at price. We're looking at what the analyst is estimating about the future in a company, like you said before, Matt, that is continually getting better. The analyst will continue to raise those estimates higher and higher over time. And we institute a sell discipline when that analyst actually lowers the future earnings estimates. So when they eventually get to the point where they say, I don't think this company is going to earn the $1.50 that we previously said, we're going to lower it to $1.45 based on these particular issues or circumstances. Doesn't mean they're going bankrupt tomorrow. Might not mean anything, but it means that if you think of the train or the horse, you said stallion before, they said that's pulling the stock price along. It's time to derail. It's time to unhitch from that particular company and move on to another company. And so what to buy, when to sell, really, really important. And then having certainly that third question answered is, where do you reinvest your proceeds? When it's time to move on, what do you do?
So what do you do?
Glad you asked. So that's the most important part into the psychology of investors as well, is that I find a lot of the investors and the clients prospective clients that I've talked to in my career, oftentimes they've had a hesitation to sell because they didn't really have anything else to reinvest into. They didn't have an idea. They didn't have a process. And okay, well, what if I do sell this? It's been up 100%. What do I do with the proceeds? And so what we do is we reinvest those proceeds immediately in a new company on our list that has just satisfied our buy criteria. So we keep this list every day, and it features companies that have been on the list for a certain amount of time. In other words, companies that continually have their estimates raised, have not had them lowered recently. It also contains very, very new companies that have recently satisfied our criteria. And what we do is we reinvest those proceeds whenever we do sell something into a new company, and we keep that process going essentially into perpetuity.
Love that. Is this considered momentum investing? That was a question from the audience. Would this be considered momentum investing?
I don't think so. I get that question a lot. I guess it depends on the definition of that. Momentum does have an element of price, and it does have an element of when I've talked to different traders and Wall Street folks about momentum, they're focused on quarterly earnings in those announcements and so on. And we look more on a little bit further out there into the future, not looking at price, not really looking at quarterly estimates, not looking at the quarterly announcements of earnings. Although, of course, the analyst does take that into consideration when the quarterly earnings is announced, and the management sometimes gives their guidance on what the next quarter, what the next year is going to look like. That certainly is connected somehow. But momentum investing is a little bit different, but it's related.
Okay. How about this? Everybody I hear that I've ever talked to invests in funds or exchange ETFs of some kind. Mm-hmm. All I'm hearing from you is individual stocks, which sounds scary and risky. So how many stocks, and then why not funds? Why not ETFs, the low cost index fund that everybody talks about?
Wow, so many good points in there. I'll try to keep this short. So the first thing, why stocks? And why 15 stocks? So this strategy is all about, at least the investors that I talk to and the clients that we have, in so many ways, when we have an initial conversation with them, they're sitting at our table in our conference room, or nowadays over Zoom. Even though they're not maybe saying the same words verbatim, they're wanting to change. They're wanting to improve their financial circumstances, be it work towards retirement, they're already in retirement. In so many words, what they're saying is, I know there's going to be changes in the future. I know the world will innovate. I mean, I'll tell a quick story about how things in our lives today, they seem to move really slow in the day-to-day, but the changes that we see are really fast. Like, I'm down in Aruba this summer, and I get notified on my phone that there's motion near my garage. So my phone pops up and I see it's a FedEx truck backing up. So what do I do is I get on the touch an app, which allows me to speak directly from Aruba through my security Ring doorbell cameras to the FedEx driver, let him know that, would you mind to slide that into the garage? I go to a different app on my phone and remotely open my garage door, watch him put the package in, and then when he leaves, I close the garage door. And, now stuff like that to all of us, and probably everybody listening right now, like, oh yeah, well, I know, it's technology, it's today, it's normal. The fact that Domino's Pizza is being delivered in a driverless car today. The fact that Tesla has a available feature where you go park your Tesla at the mall, you go in, you do your shopping, you're about to walk out, and you notice that, oh, it's raining now. So you get out your app or you get out your key fob and you hit the summon button, and the car backs out of the space by itself. It drives itself over to where you are, on the road, and you jump in. Now, that because it's felt slow to us, as it's happened, but if we put ourselves back 20 years, to 2000, and we think about these things, this is space age stuff. But this is the kind of change that the growth strategy is built upon, and that in so many words, even though they might not be talking about that particular type of technology or about Domino's or about Tesla, we're looking to the future. We know there's going to be all this innovation and change, and how do we harness that? And how do we benefit from that in our portfolio? So individual stocks, in a way, being able to have a strategy that identifies, as you rightly put, Matt, a moment ago, companies that are great today that are getting better. Owning individual stocks that way, you're going to identify over time, not all, but you're going to identify some that nobody even knows who they are today, and they'll turn into the Amazons 20 years from now. And you want to, everybody in some way, shape, or form wants to be part of that. I want to be part of that. You want to be, and anybody listening here as an investor really wants to be part of that. And the strategy that we have, the growth strategy, is the way that we put ourselves in front of those opportunities. 15 stocks is proper diversification in a phrase. Is that how many stocks does it take in a portfolio to diversify out all of the risk that is diversifiable? And that number is somewhere around 15 in terms of the calculations that we've done in the white papers that, of course, are publicly available. And so 15 companies. So in a growth portfolio, long-term growth portfolio, you don't want 1,000 securities because your money is spread out over too many different securities. The impact of a handful of those doing well, if you have 1,000 companies, is really muted when it's all said and done. But if you have 15 companies, given that you have a very strict process to follow, focused on identifying good companies getting great, and a very strict sell discipline to make sure that if and when possible, you have a sell so you avoid disasters, you don't hold on to companies too long, is really important. So 15 companies diversifies out the majority of the risk that's diversifiable. So that's why that number is what it is.
Got it. Keep going.
I was just going to say the last thing I can think of what you asked is why not mutual funds and ETFs? One reason is that we consider them very over diversified. So they do give you the exposure to the mainstream equity markets, right? Which is very, very important. If you're not doing anything else, you're not doing bonds, no bonds, right? So so you're doing the first thing is want to be invested in equities, in owning an S&P index fund or a mutual fund focused on growth or equities in general. That's certainly important. The difference, I'm not going to say issue, but the difference between what we do and what those funds do that have a lot of securities is that we give a concentrated nature to it. We own the individual security in a properly diversified way so that when you get in front of an opportunity like this change that we're talking about, you'll feel the impact and you'll have the ability to, own a security at $20 a share and still perhaps be owning that when it's at $1,000 a share. And that's really important. And it sounds strange. I might say it sounds strange to hear that, but when you own a security, a stock, and you continue to own it for a reason, and that reason is that the future continues to get bright for that company, and you have a strict sell discipline that prevents you from selling that based on the fact that, it went up 100%, so I made 100%, so I should sell it off. Instead of looking at price, you can keep looking at the future. As difficult as it is, the market's doing what it is, but you keep your ironclad focus in the future and what that analyst is saying, and maybe it goes down 10% that day, and you keep holding on because the analyst keeps raising estimates. That is the path to achieving superior capital appreciation in a stock. And it's a characteristic of very successful investors, and we replicate that.
I love it. A good question from a listener, and we're running short on time, but I want to hear, speaking of risk, 15 sounds risky. Talk to me about what happens in a bear market.
Sure. Well, I think it's important when we talk about the term risk, because the term risk is used a lot in our industry, and I think it's important to understand the term risk. In the term risk, in our line of work, when we work with individuals, and we don't work with anybody short term, right? So we work with folks that have long-term financial aspirations, retirement, or if they're already retired, they need their money to last the rest of their life, right? So a 65-year-old retires today, married couple, one of the spouses is statistically going to live until they're in their 90s. So we're talking about 30 years, 3 decades plus. So risk, properly defined here in this context, is the probability of meeting your financial objectives. A 15-stock portfolio is volatile, not risky. A 15-stock portfolio is volatile. It has periods. Yeah, exactly. So it has periods of time where the value of that account or those stocks can swing and swing wildly, right? We go through periods of time, look, we have one just in our backyard here with the pandemic and the shutdown where the markets fell about 35% or so, maybe 40%. 08 and 09, there's all kinds of periods. Actually, we average in the markets, a bear market, which is, by the way, defined as any movement down in the market by 20% or more. We've seen about 9 of those over the past 40 or so years. So basically how that works out, at least historically, is once every 5 or 6 years, we see an average fall in the market of about 33%, which is substantial, right? And so it's really important to note that despite that, the mainstream markets have in the long term averaged about 10% per year in appreciation. So the short term fluctuations that we see is not risk. Risk is the probability of you meeting your long-term objectives. Volatility is the movements, these wide movements up and down that we see over shorter time periods. So this strategy, or any equity strategy for that matter, but I'll say this strategy might not be appropriate for everybody, right? Whoever you are, if you're not willing to subject your money to volatility, then it's not appropriate for you. Right. But for the folks that are looking forward and saying, okay, I understand that being involved in the stock market can be volatile, I'd like you to remove that word risk from the vocabulary, at least in that context, because risk has to do with, I'm 60 or I'm 50 and I need this money. I need to grow this money at 50 so I can retire comfortably. And then I need this money to continue to move along at a pace that outpaces inflation and also last the rest of my life. We deal with a lot of clients like that. We deal with a lot of clients that have a lot of money, and they're certainly retiring, but they want, their objectives are legacy. Their objectives are impact. Their objectives are not necessarily just having enough money for me and my spouse to enjoy retirement, but I want to make a difference in the world. I want to pay for my grandchild's or a portion of my grandchildren's education when that time comes years down the road. So I'm willing to subject my assets to volatility, understanding that at least historically, the markets have moved higher, and I'd say have moved relentlessly higher over time, to the tune of about 10% per year.
Awesome. So we're short on time. Summarizing the strategy, we buy when an analyst revises the future estimate up 2 times in 6 months. This is for all the do-it-yourselfers out there.
Right.
You're going to sell when that analyst revised the future estimate downward, and we reinvest in a newly minted buy company that satisfies that buy criteria. We look every single day. We trade every 6 to 8 weeks, which we didn't mention, but that's important to note. And that cycle, that disciplined process happens in perpetuity. Now, what if I heard all of this, everything you had to say today makes sense, but I just want to read more about that or learn more about that? Let's finish on how can we get a copy of Dancing with the Analysts, which totally changed the trajectory of my life, and how can we get in touch with any of us?
Well, a book is great, but you got to talk to my man, Matt Morizio. So that's number one. So reach out at social at Beck Bode Growth and says, I have to talk to Matt. That's number one. But what you're, all jokes aside, is that, the book Dancing with the Analysts, which you're referencing here, is a novel. So it was written by my mentor, a gentleman by the name of David Malik, that created the principles behind our strategies and how we run things today. And it's a great book to learn at your own pace and understand not only about the strategy, which, by the way, everything mentioned about the investment strategy in the book is exactly how we run things within our company, but also what I think is really effective is the lay of the land. One of the things that the novel does, it gives you a good idea, because you might be sitting here watching thinking, well, geez, I don't know, should I be in real estate? Should I be in insurance? Where should my assets be? And the book gives a really, what we view as a really accurate and reasonable, realistic account of what, anybody with dollars that they want to invest or put somewhere for their future, there are different options than our growth strategy out there, right? So you want to be well educated about what's out there. And I think the book does a good job of that. And Dancing with the Analyst by David Malik. Yeah.
So if you DM us, Beck Bode, Ben Beck, Matt Morizio on Instagram, pretty active, or any social channel, we'll get you a copy of that book. We'll mail it happily. We lead with education. I think that's the most important piece. Yeah. Far too many people I speak with will spend more time reviewing their next Amazon purchase, which might be sub $50, than they do with selecting someone to manage their entire life's worth of work. So I think there's a problem there. This book will help break down that educational barrier that you think that might exist. So Ben, thank you for this, man. This has been fun. I could have gone forever, but we're already over time.
I had a feeling we were going to go over time anyway, but I think we're going to have a growth strategy part 2 because there's so much we didn't cover. But
I know there is. But
this is great. Thank you, Matt. Thank you, everybody, for listening, for tuning in, or for those of you, I saw a number of emails come through about wanting to know if there's a replay. There is a replay. The great Angel Williams will be sending that out shortly after this recording is done. So fear not. Anything else, Matt, that you have? Parting words?
No, that's perfect. That's terrific. Thank you for this.
Awesome. Thank you. Thank you, everybody.
All right.
And we'll look forward to the next No Bondcast coming up soon.
Absolutely.